The 4% rule, also known as the safe withdrawal rate, is a guideline used to determine how much money you can withdraw from your retirement savings each year without running out of your funds over time. This rule is not only backed by solid research, but also very easy to understand and apply to your retirement planning. It all began with a financial advisor named William Bengen, who came up with the idea back in the mid-1990s. He analyzed decades of data on bond and stock returns, going all the way from 1926 to 1976. Before Bengen's groundbreaking revelation, financial experts believed that 5% withdrawal rate was the key to sustainable financial independence, but Bengen's research proved otherwise. He examined market returns starting from 1993, assuming certain rates of return for stocks and bonds. Each year, he adjusted the portfolio after withdrawals. Through his experiments, he wanted to see if an investment portfolio for someone retiring in 2023 would last until 2073. Talk about long-term planning. And guess what? Bengen found that most portfolios with a 4% withdrawal rate lasted for 50 years or more. Even those that didn't meet the full 50-year mark still lasted around 35 years, which is more than enough for the majority of retirees. Now that we know the backstory, let's dig into what the 4% rule really means. A lot of people wonder how much money they'll need to retire early and how much they can withdraw each year without going broke. While there's no one-size-fits-all answer, Bengen introduced the 4% rule as a potential solution. It serves as a guideline for financial planners to estimate a safe and steady income stream for retirement. According to this rule, retirees can safely spend 4% of their investment portfolio each year adjusting for inflation. And the best part? Most portfolios following this rule last for at least 30 years, with many lasting 50 years or more. Of course, life expectancy plays a significant role in determining the withdrawal rate. Those who live longer need their investment portfolio to last even longer, considering the rising health and other expenses. That's why the 4% rule remains relevant and effective, even when health costs come into play later in life. This rule suggests that we can spend up to 4% of our investment portfolio each year adjusted for inflation in subsequent years. So imagine you have $1 million for your retirement. You can comfortably withdraw 4% of that amount, which comes to $40,000 in the first year. Let's say the inflation rate is 4%. In this case, you can withdraw $41,600, or $40,000 times 1.04. However, in the unlikely event of deflation, where prices decrease by 4%, your takeaway amount would be $38,400, or $40,000 times 0.96. The same procedure applies to all following years. One common misconception about this rule is that the 4% benchmark is an absolute value for all years. In reality, the 4% applies only to the first year, and subsequent years require adjustment for inflation. It's important for financial planners to keep this in mind. Now let's break down the underlying assumptions of the 4% rule, especially when it comes to asset allocation. After conducting numerous trials and tests, Bengen concluded that 50% of investments should be in stocks and the other 50% in bonds. This allocation allowed Bengen to test various withdrawal rates for the first year. Here's what he found. When using a 3% withdrawal rate, every portfolio in the study lasted at least 50 years. On the other hand, not all portfolios using a 4% withdrawal rate lasted for 50 years or more. Some lasted between 30 and 50 years, mainly due to the below-average stock market performance. And more than half of the portfolios with a 5% withdrawal rate lasted less than 50 years, with the worst-performing portfolios lasting less than 2 decades, while only a few portfolios lasted more than 50 years with a 6% rate, and some even lasted less than 20 years. The experiment results show that the withdrawal rate is inversely proportional to the lifespan of the investment portfolio. It's important to note that these studies were based on historical data, and that future returns may not align with those from the past. Some financial experts believe that future returns from 2023 to 2073 might be lower than historical ones. Interestingly, holding too few stocks proved to be more disadvantageous than holding too many. For optimal longevity, a 50-50 investment in bonds and stocks is recommended. However, if you're aiming for wealth creation, increasing your stock allocation from 50% to around 75% is advised. Keep in mind that some retirees may find a 50% stock allocation quite risky, and increasing it to 75% would be even riskier. Nonetheless, for the 4% rule to remain applicable, the stock allocation needs to be increased. When thinking about your future expenses, it's important to consider inflation, which will make your money less valuable. To make sure your income stays in line with the rising cost of living, it's important to adjust your withdrawals for inflation. This way, you can protect the purchasing power of your money and maintain a comfortable lifestyle. You might think that during the Great Depression of 1929, portfolios would have been in deep trouble, right? Well, prepare to be surprised. Those who retired in 1929 actually had investment portfolios that fared quite well, lasting a remarkable 50 years. However, retirees from 1937 to 1941 experienced a slight decrease in longevity to 40 years. The real shocker came from those who retired in the infamous 1973 to 1974 era. So what caused this disparity, you ask? The answer is inflation. During the 1973 to 1974 period, inflation soared to an alarming 22%. This meant that retirees had to withdraw a higher percentage from their portfolios just to keep up with rising costs. Consequently, the overall lifespan of their investments took a hit. In contrast, from 1929 to 1931, there was actually deflation of 15%. So while portfolios did see a significant drop, retirees still had the flexibility to adjust their withdrawal rate without compromising their purchasing power too severely. Now, let's talk about dynamic withdrawal rates. Many folks mistakenly perceive the 4% rule as a fixed number that applies forever, but that's not the case. The withdrawal rate should actually be adjusted annually to account for inflation, or deflation if we find ourselves in that rare scenario. This flexibility allows retirees to adapt their withdrawal strategy based on the economic climate. For example, during a recession, a savvy financial planner might opt to lower the withdrawal rate. This helps maintain the purchasing power and extends the lifespan of the investment portfolio. The previous estimates we discussed didn't factor in trading fees for stocks or bonds. These fees can eat into our overall returns, making our initial estimates a tad optimistic. Fear not, though. Investors with low-cost index funds won't be affected much, as these fees are negligible. However, if you're one of those who hires a financial planner, the 4% rule may not hold as firmly. It's a common practice for financial advisors to charge at least 1% annually of the assets they manage. If the portfolio is actively managed, those fees can reach up even higher, up to 75 basis points or more, resulting in a total fee of 2% or beyond. In such cases, it becomes highly unlikely that the 4% rule of financial independence will prove effective. Now, let's tackle a burning question. While we've explored some factors that can impact the rule's validity, there are additional scenarios where it falls short. One major threat is experiencing poor market returns during the initial years of retirement. This can quickly deplete the investment, potentially exhausting it before the 30 years have even passed. Unfortunately, there's no magic crystal ball to protect the market performance once you retire, but staying informed about market trends can certainly be a game changer in the long run. Another aspect the 4% rule fails to account for is the unpredictability of market swings. Picture this. Someone retires in 1929, blissfully unaware of the impending Great Depression. Similarly, those who retired in 2007 had no idea of the looming financial crisis. Yet despite these economic downturns, individuals who retired during these turbulent times saw their investments survive for more than 30 years. Now that we've covered the factors affecting the 4% rule, let's shift our focus to the pros and cons of this rule. First off, the 4% rule offers a promising potential. By adhering to this rule, your investment portfolio has the potential to last a whopping 50 years or even more. That's a pretty impressive runway for your retirement income. But, and this is a big but, it's essential to note that this rule is derived from historical data. The future might throw us some curveballs, and what worked in the past may not hold true in the future, so it's important to keep an eye on changing market conditions and adapt accordingly. Simplicity is one of the key advantages of the 4% rule. Unlike some complicated financial strategies that make your head spin, this rule is refreshingly easy to understand. You withdraw 4% in the first year, adjust for inflation in the subsequent years, and voila! You have a predictable income stream. It's like having a trusty roadmap for your retirement journey. Now, let's talk about a couple of drawbacks to keep in mind. The 4% rule demands discipline. It's not a flexible guideline that adjusts based on your changing expenses. You have to stick to that 4% withdrawal rate even if life throws unexpected financial challenges your way. Deviating from the rule might compromise the longevity of your investment portfolio, and that's definitely not what we want. Another point to consider is that the 4% rule is based on a worst-case scenario. It assumes that you'll face poor market returns in the early years of retirement. While it's a conservative approach to ensure your portfolio lasts, it may not always accurately predict market swings and unexpected economic downturns, so it's essential to keep a keen eye on market trends and be prepared for the unexpected. To sum it up, the 4% rule of financial freedom offers a simple and significant guideline for retirees. It provides a clear path to plan your retirement income, and if everything aligns perfectly, your investment portfolio can last for decades. However, it's crucial to remember that this rule isn't foolproof. It's important to stay informed and adapt to changing market conditions and consider factors like inflation, fees, and unexpected market swings. That's a wrap for today's video. If you found this information valuable, don't forget to hit the like button and share it with your fellow financial savvy friends. And if you want to stay in the loop and receive more epic content from the world of finance, make sure to subscribe to Growth Mindset.